Welcome back to my channel, Balance Sheets Matter. It's been a while since I've done my last video. I've been very busy with my business, but I'm going to get back into doing my stock analysis videos regularly again. So let's start it off by looking at Edwards Lifesciences Corp. EW stock. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get ideas on potential stocks to buy or value traps to avoid, make sure to subscribe to my channel. And if you do want me to look at a stock, make sure to leave it in the comments below, and I might get to it in the future. So let's take a look at the kind of higher level things on Edwards Lifesciences here on Guru Focus. You can see right now they have a $55 billion market cap, which that will come in a little bit later. And you can say they do have a relatively high PE of 40. So we're going to see if this is really overvalued or there's a reason that justifies it. Because as we look at the Guru Focus value band here, you can actually see it's showing a little bit undervalued, even at $92, and kind of saying fair value is maybe even like closer to 100. And myself, I actually own this stock already. I own a few hundred shares at about $74. So pretty reasonable price. I think I got it back here during this dip. And we're going to go over the financials, and you'll see a little bit of my thinking of why, even though this is a high PE stock, I still felt it could be a good value. And you can see with the forward PE, it's about 33. Another thing, they don't pay a dividend, but they do some share buybacks. So that is something we're going to have to take into consideration. So let's pop over to the 30-year financials here. And you can see their growth has been quite strong. You can see on the right here, there's the little chart here, and the revenue trend line is about an average of 10% a year, and that's also going forward in the future. So that's pretty strong growth going forward, and that's being reflected by what we can see here. The last 10 years was actually 12.5%, with our EPS actually growing much more rapidly at 19.5%. Now let's dive into financials and see why that is. So you can first see the revenue, basically top line over the years, is growing quite strong, and we are reaching new revenue highs basically, and also the gross margins over the long run, it has been growing as well. If you look back basically at maybe between 2008 and 2011, they were at about 70% or even lower for the gross margin. We're now there at about 77%, which is much higher, and they did have a little bit higher in 2022, but this is kind of one of these one-off oddities, and these are these things you kind of have to take into consideration. Because you can see here in 2022, basically, they did have a little high of EPS of 2.46, quite rapid growth, and it's contracted a little bit. And maybe that's why the stock's actually down, is things got a little bit ahead of itself. But if we look from the longer term perspective, should we really be worried about the gross margin going from about almost 80% down to 77? Well, if we look in the years before, it was 76, 75, 74. So this is overall growing the gross margin. So this is actually a very good trend. And maybe this is just presenting us an opportunity because we had the one little year that was a little bit ahead of itself. You can also see basically the operating margin, similar thing. It's been growing at quite a nice pace too. And again, in 2022, got a little bit ahead of itself at about 33%. And it's come down to almost about 29% right now. But that's still a lot better if we look before pre-2020, any of those years there. And also what that kind of tells us is that the selling and general admin and research and development are not kind of growing disproportionately to how the revenue is doing. So that is a good sign, and this is what we want to see of basically the gross margin expanding and the operating margin expanding, since what we're seeing is Edward Lifesciences here, EW stock, does have a good competitive moat when we see these gross margins expanding basically. So we get down to the interest income and interest expense. You can see they do have a little bit of interest income, probably investing in some treasuries from the cash they have, and their interest expense extremely low, almost nothing, because this company has very little debt they're paying interest on, with positive net interest income overall. And even in the past, it's pretty much net neutral, little positive, little negative. You have sometimes some yearly write-offs up and down. You should probably take this into consideration. If you do see an abnormally large number, it might not give you a full representation of the stock, of what's happening with the stock. And also, if you have an abnormally low one, it also can kind of give you a little bit of an overinflated idea of what's happening with the stock. So we kind of have to look at things right now. Maybe 181 million is a little bit high. So let's go further down the income statement here. You can basically see the net income has been growing. We're at $1.4 billion. And again, that's a little bit down from the 2021, 2022 numbers, but we know 2022, a little bit abnormally high, basically gross profit margins before, which helped that. And in 2021, it was also this positive other basically income, which is not going to be recurring in the future. So, well, it does look like the income's contracted. If you compare it to these previous years before 2020, it really hasn't contracted, and it's actually growing long-term quite at a nice pace. and that's also reflected with the EPS, and the EPS is outpacing the net income a little bit because they have been buying back a lot of shares. Well, not a lot of shares, but they are buying back shares. So you can see right now, 607 basically million shares. And, that's been reducing down from, say, about, 10 years ago when they had about 709 million shares. So they are reducing that share count, which is a good sign. But, their PE is a little bit high. So it's not being returning that much to shareholders at the end of the day. So you wouldn't want them necessarily just dumping all their cash into this, but we're going to see that a little bit later. So we're going to take a look at the balance sheet here. The current assets sitting at about $4 billion. Really good. They got a lot of cash and cash equivalents, probably how they're making some of that interest income of about $1.6 billion, and receivables, inventory, all the various good stuff there. And basically total assets of almost 9.4 billion, 9.363. And we do have to factor in that does have some intangibles. I feel probably because they are in the health industry and they do basically deal with like a heart kind of medical devices. This the IP they have from these intangibles probably is real value. So it's just we're going to have to look at subtracting the goodwill, which is about 1.2 billion. So keep that in mind as we go a little bit further down. And we can see total current liabilities very low, only just under $1.2 billion here. So they have quite a bit more current assets than current liabilities. So this is a very good current ratio because they're sitting at $4 billion of current assets and they only have $1.2 billion of current liabilities. So this is a very strong current ratio. And this might be one of the reasons why the company does trade at a higher PE, because they are incredibly strong on the balance sheet, because balance sheets do matter. And we can see even long-term liabilities, only just under $1.5 billion there. And what do we have? A little bit of long-term debt. They have this for whatever reason. They could basically pay it all off if they wanted, but sometimes they get such favorable rates, they're just paying probably pretty low interest rates on it. And then they also basically have a little bit of capital leases and some other long-term liabilities. But overall, total liabilities, $2.6 billion, just over that, almost nothing, basically leaving us with like total stockholder equity of $6.7 billion. But we do kind of want to take out that $1.2 billion of goodwill, which I think leaves us around $5.5 billion. Now, remember I said the market cap was important. This is one thing you have to consider when factoring in stocks that do have very strong balance sheets, are growing, and do look a little bit more expensive. They have $5.5 billion of mostly tangible equity. A lot of it's cash, or if we can just consider the full thing, this is about 10% of their entire market cap is in tangible equity. So you can kind of reduce that valuation just by 10% just because of this, because you're paying for the company and you have $5.5 billion in assets there. So now let's look at their cash flow statement here. You can see overall cash flow from operations, it has been quite positive. There is some stock-based compensation going on, and this probably is a good reason why they should be repurchasing some shares, just to offset this, because you don't want that share count really going up. And if you do really have a long-term growth perspective, prospects in front of you, when it seems like it might be expensive at this 30, 40 PE ratio, it might not actually be that expensive if you're going to be expanding your margins quite a bit in the future. Another important thing to basically look at is we want to look at the cash flow from depreciation. So you can see cash flow from depreciation is up to about $145 million. It's been relatively low in the past too, but the purchase of plant, property, and equipment is a lot higher. So while they do have this cash flow, they are actually reinvesting a good chunk of money back into expanding their business and their underlying operations. And this is something you do want to look at basically every company, see what the ratio is going for this. And usually in the long run, these should stabilize out against each other when they're kind of just doing replacement. But if they're actually growing and they are spending more, this does show they are making reinvestments into their business and it is growing, and this is good capital being deployed. There also is a little bit of purchase of businesses along the way, but these are very, very small. So they're not doing these big acquisitions, which might kind of hint that they're in a lot later stages. So the very fact that these are very small, probably strategic ones, that's a good sign, because they're actually quite a bit smaller, relatively speaking, to the amount they're just reinvesting into their main business there. It looks like they do have a little bit of purchase of investment and sale of investment going on. This is sometimes treasuries or currency hedging, something around that, because it looks like basically anything going in is also going out at the end of the day. So as we go down a little bit more, you can see they actually, basically since 2011, they haven't been issuing any stock other than that stock-based compensation. And they are repurchasing a fair bit of stock, Pretty good chunks though, so they are there. So even though they are building up cash on the balance sheet, they are putting a little bit back basically to offset those shares repurchasing. And more than that, to reduce that share count overall, which, some people may feel they're overpaying for it, but if they really do have a long-term growth runway, this might actually still be a very good time for them to repurchase stock. And then we can see the free cash flow overall. It's been positive all these years. So overall, like Edwards Lifesciences is in a very strong financial condition. They're basically, growing their revenue at 10% per year. Their EPS is growing faster. They're, repurchasing shares. They have, excess assets on their balance sheet, which, kind of makes that valuation actually a little bit lower, maybe not a 40. Maybe it's really about a 36 factoring in that 10% like I was saying. But let's take a look at the interactive chart here and kind of look at my relative type of valuation I like to take a glance at. So we look at the revenue with estimate we already have there, and you can see that 10% here. Now let's get the EPS with estimate up as well. And yeah, we're basically kind of in line growing long-term. The EPS still starting to grow basically 10% per year. But you can see sometimes you get this. Let's just take the revenue off here. You can see in the long run, while the revenue is quite steady, sometimes you get these abnormal blips up in the EPS, and then they come down, they kind of revert. And that's kind of what we had here. And then when things look like going flat, the stock comes down quite a bit, but we're actually just reverting back to this long-term trend. So that's a good sign to see already there. So now let's bring up a few different metrics here. I'm going to bring up the price to sales ratio. And you can see the price to sales ratio does look kind of high. I'm going to bring this little bit shorter time frame here. Let's take it down to say 15, maybe even 10 years here. Let's go 15. I'm going to actually take off the price of the stock just so I can see it's a little bit clearer. And they are a higher price to sales ratio basically from the further pass back here, but compared to recent times, they're quite a bit lower. But what's going to support a higher price to sales ratio as time goes on? Well, basically higher net margins or higher gross margins. We're going to bring up basically the net margin here and, kind of justify this. We should see this net margin growing in the long term. And you can see basically back here, the net margin was maybe only 14% and, justified that lower basically price to sales ratio. And now it's in the 20%. Is it going to maintain up back to these levels? Well, it might get back up there, but right now it's about 23, which is low contraction probably has led to the stock dipping. You can expand this out a little bit further here, and you can see their net margins have been growing quite a bit in the long run. And that kind of is why we are seeing that price to sales multiple expansion. And when you compare that to the price, it's kind of the typical thing. When the price to sales ratio is relatively high, the stock was high. And when the price to sales ratio is relatively low, it sometimes is a good time to buy the stock. So as long as they grow, like their net margins are expected to basically maintain or even grow in the future, this is already probably looking like a pretty good time to buy the stock. We can also take a quick look at the PE ratio, although for stocks that are growing their basically their margins so much, PE is not always the most useful thing to always look at, but we can kind of compare it to its past and see that, well, yes, Edwards Lifesciences here has always traded at a high PE, and sometimes these high quality companies, when you get into a high 20 PE ratio, that sometimes is when they are cheap, and when they're in the 30s, sometimes that's kind of when they're more fair valued. And Edwards Lifesciences here, since probably they do have more net margin expansion in the future, that could very well be the case. So you can kind of see that before they've traded very high, they're back up to a 40 right now, but they're probably forward PE is going to be, well, as we know, it's 33, so it's already a lot lower. So kind of relatively speaking, you can kind of see when I was starting to see Edwards Lifesciences with all its fundamentals and strongness, why I basically decided to take a position in it in early 2023, came back up, dipped back down, I added a little bit more, and now we're off. It dips down again. I might buy some more, but we're going to see how that goes. So let's take a look what that looks like on the chart here. So we bring this up here, and I kind of draw on my long-term trend channel just to kind of represent what might be a fair value for it in the future. As you can see, strong uptrend. It took a big dip down to more of this lower channel, and getting on this 100 monthly moving average, and it's come off it quite strongly. So fundamentally, I think the stock's pretty good. If they can keep their net margin expansion up, basically they're going to keep going with this trend. When it does finally plateau, they probably will kind of start tapering out this trend, and it will slow down a little bit. But I'm not seeing any signs of them fundamentally slowing down right now. The analyst estimates seem to think they have good growth prospects going forward. That's why I bought the stock, like I said, about $74 here. Let's just, mark that off, just kind of give an idea. If they did back down, come down again, I probably would buy again, but if they get back up, I'm just going to keep holding them until they kind of get more into this upper range here, and that's when I would look at basically selling them. So I hope you like this stock analysis. I hope it gave you some little bit of insights maybe into EW stock here, Edwards Lifesciences, and I'll see you in the next stock analysis. Make sure to subscribe to my channel, Balance Sheets Matter. Leave a comment if you want me to look at another stock in the future.